better than Rahul Malani to actually throw light on that. Rahul, to talk about the macro stability report firstly, I want to get your focus in on what it would mean or rather spell for banks, because it's clearly talking about slower deposit growth, tight liquidity, plus the new LCR norms, which are applicable come April, and that could perhaps continue to have a slowdown impact on the credit growth. Help us analyze what's been your takeaway of the stability report.
So you rightly alluded that the current headwinds will at least continue in H1 of calendar year 2025. So deposit growth has been slower, but the key positive takeaway is that there has been convergence with the deposit growth with the credit growth. However, the tight liquidity conditions plus the new applicable LCR norms plus the retail unsecured growth has been tapered off. So, which is resulting in the credit growth slowdown. Plus, the private capex has not picked up, which is indirectly leading to the slowdown in the credit growth. Apart from that, there are other current headwinds which could emerge at least in the H1 of calendar year 25, which is that NIMs could be under pressure if the lower interest rate cycle kicks in. So the current market expectation is around 50 basis points to 100 basis points. So the combination of lower growth plus lower NIMs would lead to weak NII growth. Apart from that, we do not see asset quality issues settling for the unsecured segments at least in the H2 of FY25, which the management commentary had hinted earlier. While in the current regime, we believe that the current bureau data point suggests that the stress will be spilled over in the H1 of FY26, that is the H1 of the calendar year 25. So basically, all in all, we believe that here asset quality will remain under pressure, which will lead to higher credit costs for the unsecured segment. Apart from that, there could be final guidelines on the ECL provisioning and project financing, which could ultimately lead to additionally higher credit costs. But for that, there will be a path for a glide path for over the next 3 to 5 years. But let us see. Overall, we believe that there are no earnings trigger or earnings upgrade over the next 6 to 8 months. So, despite valuations have been reasonable and steep correction in some of the lenders, we remain on sidelines.
Rahul, also help us understand with respect to your take on the valuations on some of these small finance bank companies, because like you rightly mentioned, there has been stress in the unsecured lending, but given the correction and like you're saying that we could be in for some more stress in the unsecured segment, do you believe that in the next 6 to 8 months this segment could offer good opportunity to accumulate? What's your take on the valuations, and would you be a buyer at these price points and valuation?
See, the argument you mentioned is right that there has been a steep correction and valuations are cheap for some of the small finance bank and some of the lenders which have been seeing higher stress in the unsecured segment. But we do not see stress peaking out at least in the next 6 months. First sign of stress peaking would be seen in the DPD 0 plus, where the collection efficiency will start to improve. That will be the time that we should see accumulating the stocks like most major SMBs and other lenders, as well as the NBFC and MFIs which have been noted down by the market. So first sign would be the improvement in the collection efficiencies. That will result in the reduction in the portfolio at risk, because current bureau data suggests that there has been a consistent increase in the portfolio at risk value till November month. Apart from that, specifically in the MFI group, but if specifically talking about the segmental in credit cards, there has been stress has been not been reduced. Elevated flows are there in SMS, but these are not increasing. So overall, at least it will first sign of improvement should be the collection efficiency. Then you can take on from there.
Point taken, but given all of that you're talking about in terms of credit growth, valuations, MFI pain, etc., if you had to make some of the top recommendations for 2025, where you see the most upside, what's the pecking order for you?
So, preference orders for the calendar year 25 would be in the large private bank space. We continue to like ICICI Bank and HDFC Bank. In mid-tier private banks, we like Federal Bank, and in PSU bank space, we like SBI and BOB. Given there will be stability in the return ratio as well as the growth will be if we rest aside HDFC Bank, the growth will be at par greater than the system growth. So despite the sectoral headwinds, this name would perform better than better sector and thus it remains our top pick.
Note, we let you go. Thanks so much for joining us.
If you like this video, then like, share and subscribe to ET Now.